Why in the world is it suddenly getting harder and harder to get a mortgage or even a refinance? If you want to know everything from living, dining, sleeping, buying, and selling in the Detroit Metro, hit subscribe and tap the bell because I have new videos coming out weekly. And I absolutely love when people call me, text me, or email me because they're thinking about buying or selling here in the Detroit Metro. So if you have any plans to buy or sell in the Detroit Metro, call me, text me, email me, or even send the pigeon carrier because I've got your back. Mortgage rates have fallen back to recent lows, and though homebuyers aren't exactly banging on the doors during the spring housing market amid the coronavirus crisis, there are some hardy ones out there in the hunt. And there are still plenty of current homeowners who could save money through a refinance. And unfortunately, both types of loans are now harder to get as the mortgage market is badly battered on several fronts due to the impact of the pandemic on the economy and employment. Mortgage credit availability in March fell to the lowest level in 5 years. And according to a survey by the Mortgage Bankers Association, lenders cite a large drop in liquidity as investors in jumbo mortgage-backed bonds now are pulling back. Jumbo loans are those valued above the conforming loan limit of $510,400. In early last week, Wells Fargo, the nation's largest mortgage lender by volume, temporarily suspended its purchasing of non-conforming loans from correspondent sellers due to unprecedented market conditions. It is also scaling back its own retail originations of non-conforming refinances and conforming high balance loans. So what are now the new guidelines? JP Morgan Chase, another one of the largest mortgage lenders, changed its underwriting guidelines. And as of this week, new mortgage applicants will need a minimum FICO score of 700 and will have to make at least a 20% down payment on a home. Mortgage servicers are being besieged by calls from borrowers requesting the government's forbearance program, wherein borrowers can miss up to a year's worth of payments, which will then have to be paid at a later date. And the servicing has been begging the Federal Reserve for some kind of liquidity facility to help them make their payments to bondholders, but so far only Fannie Mae has done that for FHA loans. The lack of liquidity is putting the whole servicing industry at risk and adding to a growing list to tighten lending. And as for liquidity and overall lending, the Fed did step in and is now buying billions of dollars worth of conforming mortgage-backed bonds. But there is much less liquidity for other types of lending. Investors simply don't want to take that risk. And several non-bank lenders are also raising minimum credit scores for FHA loans, which are generally used by buyers with lower scores and lower down payments. The FHA itself has not changed its guidelines, but adding to the difficulty in originating mortgages for both new home purchases and refinances are changes to underwriting guidelines by Fannie Mae and Freddie Mac, who purchase the majority of mortgages today. And they are requiring that all income and asset documentation for borrowers be dated within 60 days of the initial application, compared to the 120-day standard time frame. And this is all likely because people are losing jobs and income at an unprecedented rate. And for self-employed applicants, lenders must verify the existence of the borrower's business within 120 days. That has now shrunk to just 10 days. Longer time horizon given how difficult the whole mortgage process now is, with title companies closed or working remotely, and notaries and appraisers unable to do their work in person, the time horizon for closing a loan is only getting longer, not shorter. And typically, following natural disasters, they will do just the opposite, extending that time frame to 180 days before a lender would have to re-verify a borrower's income and assets. And only 2 months ago, before this all started with the pandemic had struck the US widely, mortgage rates were near record lows and refinancing demand was booming. Applications jumped dramatically, but now even some of those applications will be rejected either due to timing issues or because buyers no longer qualify. And for the home buyers, there is still some out there. The time of locking in a mortgage rate and then getting all the way through closing on a home has lengthened dramatically, putting the availability of getting that mortgage at risk. And some title companies are experimenting with drive-through closings, keeping up with social distancing while still selling homes.